A pretty rough year for the markets. The S&P 500 at the moment down about 20% on the year. But if you look beneath the surface, actually some pockets of strength. Joining us now for more is Ben Gossack, portfolio manager at TD Asset Management. Talk about some of the push and pull you're seeing out there, Ben. Welcome back to the show.
Great. Thanks for having me back.
So let's talk about it, right? We look at the headline numbers just as we did there, the S&P TSX Composite Index, the S&P 500. Beneath the surface of that, as you take a look at the sectors, what kind of story are they telling you?
Yeah, so I mean, the S&P 500 is supposed to represent the top 500 companies in the US. However, it's not equally weighted, and some companies take up a bigger share. So, for example, Apple is about 7% of the index. And so while most people will say that the market had peaked January 3rd, January 4th of this year, that's, I would argue, is when Microsoft or Apple peaked. Many stocks or sectors within the S&P 500 had already peaked and had been falling well into 2021. Which was sort of picking up the reasons why we are where we are today. What's interesting about this year, yes, I think we were down almost as much as 25 to 30%. We're at 20% today. We'll see where we go with the next couple of risk events. But it doesn't mean that there are not opportunities inside the market for you to invest and for you to create value. One of the areas that's seen the biggest amount of strength is in energy. I think it's the only sector now today that's up year to date. All the other sectors are below zero. But when we compare it to the S&P 500,
as we're doing in this chart here, right? This is comparing what we've seen out of energy versus the S&P 500, the broader market.
Right. So what you're looking at here is I take the sector and I put it over the S&P 500. And so the scale itself doesn't really matter, Greg. What really matters is the direction. So think of it as the first derivative, second derivative. We're looking for a change in trend. And for the longest time, energy had been underperforming the S&P 500. At its lowest point, it was 2% of the index. We've seen energy rally 2021, 2022. It's only at 5% of the index. So you think, okay, can these stocks continue to do well? Yeah, they've just started. And so while we're off the peak of oil at $120, supply has remained constrained. OPEC has demonstrated discipline, and so while there are still unknowns about a recession, the companies are delivering the financial results, and shareholders are being rewarded with dividends and buybacks, and that's why the sector has continued to work.
All right, so that's the energy sector. You have a few more to go through here. Let's talk about the financials. What do they look like in this environment?
So financials are interesting, and if I were to tell you, Greg, the economy is slowing down, there's a lot of debt out there, while interest rates are going up, you're like, I get that. I'm a little bit more worried about the credit provisions because they come right off the bottom of the financial model. And so we have seen a weakness in particularly the US banks early in the year, and that has helped to sort of weigh down the performance of financials relative to the S&P. But what we're seeing lately is that there is a pocket of strength right now in the financials. Now, when I say financials, most people think of banks. But what they often overlook is insurance companies. And so while the market, again, down 20%, insurance companies are breaking to new highs. So they haven't seen the impact of a Russia-Ukraine war. They benefited from rising interest rates. They haven't had to worry about the fears of provisions. We have had natural disasters like the recent hurricane in Florida, but sometimes that's treated as a one-off event. But for the insurance companies, especially companies that do property and casualty, their asset book is quite short in duration, so they're able to reprice their book. And a 4% interest rate world is a lot better than a 0% interest rate world. And then as the rates rise, insurance liabilities start to look a lot better. And so insurance on both sides of the border, we're seeing in Canada, we're seeing in the US perform. And then recently for the US banks, with earnings, while credit provisions are a concern, they're not a concern yet. Probably in 2023 it looks more. And then in the meantime, they're able to lend at great rates, and they're still offering sort of meager interest on our deposits. And that's creating a nice spread for net interest income.
All right, so a great look at the financials there. This next one, I'm not going to prejudge what this chart's going to look like, but I think I have an idea of the tech space.
Right, so we're looking at, again, technology relative to the S&P 500. I would argue that this chart should look a lot worse. And the reason why the chart is not as bad as it seems is, again, you have to look through the contribution of certain stocks to the sector. So this is not equal weight. Apple is a large chunk of the exposure in US technology. Apple has been a source of strength, has remained a source of strength relative to the market, relative to its sector. Meanwhile, we have seen Microsoft take a step back after earnings. Most people are well aware of the underperformance of semiconductors. And so this is very important to understand the trends, the cycles. Technology as a sector should look a lot worse than it does right now.
Now, this next one, would this be part of the reason too? Communications. So we talk about mega cap tech coming out, the big earnings of last week, the big disappointments, but some of those names find themselves in sort of different compartments, don't they?
Right. So the company, the organization that classifies companies into sectors decided that the telecommunications sector had gotten too small. And years ago, they had moved companies such as Google, Facebook, now Meta, into the communications sector. This is one of those situations when you look at the performance of communications relative to the S&P 500, where you say it can't get worse, and then it gets worse. And so we've seen the challenges. Snap is not in the S&P 500, but the same challenges for Snap extended to Meta. We've seen the challenges for Netflix as well. This is a sector that continues to try to fight headwinds. And what has made matters worse is that Google has held up. And now Google is struggling with many of the same issues that Meta has been struggling with as well. And so communications just continues to weaken.
Let's take a look at healthcare. And of course, if you're taking a look at healthcare south of the border, it's a different kind of composition of stocks than we have here at home.
Yes, and most investors in Canada will look to US healthcare to sort of make up a more complete portfolio. What's interesting about healthcare is it's typically considered a defensive sector, but it has not been easy. If you look at healthcare relative to the S&P 500, you'd say this is great. It's doing what we thought it was supposed to do, which is provide us relative outperformance. But there's a bifurcation. So the pharma-related businesses have been holding up well, and the reason why they've been holding up well is, most of their cost is in R&D, and it's the first pill that costs the most. After that, margins are quite strong. And so there's visibility from an earnings perspective. And so even if your drug might be coming off patent 5 or 6 years from now, that's not a problem right now. And I know the cash flows are steady. So a company like Merck is breaking out to new highs. However, the med tech, which is really interesting, has a lot of secular trends, have moats, real competitive advantages, areas. Again, it could be orthopedics, it could be in diabetes. They've really struggled, and they've struggled on the margin side. And that's what we've seen for all of earnings. Any company that has issues with margins and cost pressures have underperformed. And so companies, again, well-known companies, Abbott, Thermo Fisher, Stryker, have been underperforming. You can't see it within the sector, but you'll know it if you own those stocks.
All right, and last but not least, utilities. I won't even make a bet as to how this chart's going to look. Enlighten us. Sure.
So I would lump utilities and REITs as sort of the same trend that we saw in the beginning of the year. It wasn't lost on anyone that the market was falling, growth is slowing, all of a sudden the central banks have to act. People were seeking defense. And defense is utilities and REITs. And so the stocks have been working and people were sort of hiding in that area. And then now what we've seen is that it's come apart. And the sector has just underperformed. And now I think it's the interest rates are becoming a bigger issue now. So it was okay at 2%, at 3%, but now with inflation re-accelerating, and so the Fed and other central banks really have to tighten. I would rather own the 4% US government bond than worry about a utility company, worry about their input costs, worry about how they might have been affected by hurricanes, worry about a government coming in and saying, hey, it's a problem that people have to pay these utilities bills, so we're going to cap your returns. And so I think that's starting to affect the utility companies, and that's why we're seeing that underperformance.